morning, students. Once again, welcome to corporate accounting class. Students, based on the fair value of valuation of equity share method, today we will study and try to solve one more variety of problem. Once again, I want to repeat the problem. That is, Mr. X, who decided to invest rupees 33,000 in equity shares in public limited company, seeks your advice as to fair value of share issue and paid up capital. Here, some information pertaining to the balance sheet is given. 6% preference shares of rupees 100 each, 5 lakh 50,000. Then equity shares of rupees 10 each, 3 lakh 50,000. So total of these two, say, share capital is 9 lakh. Next information, average profit of the business is rupees 75,000. Expected normal yield is 8% in case of such equity shares. It is observed that the net assets on revaluation are worth rupees 70,000 more than the amount at which they are stated in the books. Goodwill is to be calculated at 5 years purchase of super profit. Ignore income tax, give working of the fair value of equity shares and determine the number of shares which Mr. X should purchase. Use average of intrinsic value and yield basis. So this problem is based on the fair value method, one thing you have to observe. And here in adjustment you are observing calculation of the goodwill. Okay. So this is one important intangible asset which you require to calculate because the amount of goodwill is not given. Okay, so that you require to calculate because especially under the method, the net asset method or intrinsic value method, where we are calculating the total assets. Okay, because there the total asset represents both tangible and intangible assets. Okay. So calculation of goodwill is needed, without which you can't calculate the net asset available to equity shareholders. Okay. And pertaining to the say asset is concerned, no any information is given. But even though it is given, it is a little bit information. But based on the liability side approach, because the items pertaining to the liability side is given. So taking that one as the base, okay, here we can indirectly calculate here the assets that is available to equity shareholders. And let me try that problem. First one, because here first we'll calculate under the net asset method. Because fair value of equity share here it represents intrinsic value plus yield value, so divided by 2. That means here under both these two methods, here you require to calculate the value of equity share. So first one, that is intrinsic value or net assets, basis. So under this method, so how to calculate the say value of equity share. So here for total assets there is no any information. Okay, total assets. But even though here we require, because the thing is here we require to calculate the net asset available to a equity shareholders. So first one is first of all, so calculation of calculation of net assets, net assets available to equity shareholders, to equity shareholders. So why it is needed? Equity shareholders. So why we need it? Because here is formula. So net assets. So under the net asset method, value of equity share is equal to the net assets available to equity shareholders divided by number of shares. So due to that reason, here first we are calculating here as a equity, the net assets available to equity shareholders. So for which we make column like this, particulars, then amounting to this, amounting to this. Okay. Amounting to this. Yes. First one is we need the total assets. So using the liability side approach. So here we can calculate total assets. Say first one is total assets. Here the total that is given here in this problem. There is one is preference share capital, 6% preference share capital, 5,50,000, and equity share capital that is 3,50,000. So totally 9 lakh. Means to that extent there is asset in the balance sheet. So here the assumption 9 lakh. 9 lakh is the total assets. Then some any adjustment. So one adjustment is there. Plus increase in value of increase in value on revaluation. It also enhances, increases the value of assets. So 70,000. So total of, so it will be 9 lakh, 70,000. Next, so here total assets includes both tangible and intangible assets. But pertaining to goodwill, okay, so there is no information, okay, so there is no any information. So goodwill here we require to say calculate it. So by applying so whatever method we have studied. But here in this problem, calculation of the goodwill is asked on the super profit method. Super profit method. Okay. So that is why here we need that working note. Okay, that the calculation of goodwill. So here for the time being, I will keep it as a pending. Later on, I will arrive to it back. Here, working note number 1. Take here this side. So working note number 1. That is calculation of value of goodwill. Calculation of value of goodwill. Yes. For this, we need, because here valuation of goodwill is say asked on the method that is super profit method. That is also say 5 years purchase of super profit method, and we will go back to the study what you have studied in the valuation of goodwill. Just recall what you have studied in the previous say aspect. So you have studied super profit. So super profit is equal to, you know the formula. Super profit is equal to, that is average profit minus say normal profit. Super profit is equal to average profit minus normal profit. That means here you need average profit, okay, for the calculation of goodwill under super profit method. So first one is here average profit. We take here average profit. And this will make column particulars amount in rupees. Here, yes, there is average profit. Average profit, average profit. So that is given in the problem 75,000. 75,000. Okay. Then this one demands adjustment minus preference dividend minus preference dividend. So preference dividend is 6%. 6% of, so 5,50,000. So it becomes 33,000. 33,000. So 42,000 is the average profit. So one element we have calculated, that is average profit. So next we need is, that is normal profit. Okay. So normal profit, because super profit is the difference between average profit and normal profit. Here for normal profit, you know the formula. So normal profit is equal to, you know, average capital employed, average capital employed into NRR divided by 100. NRR divided by 100. That means here we need average capital employed. Okay. Then how to calculate average capital employed? Okay. So here in this problem, the information is not given. Okay. But in the working note number 2, we require to provide, that is average capital employed. I hope it is clearly visible. Okay. Now here working note number 2, calculation of, here we will take, so working note number 2, calculation of that is capital employed or average capital employed. Okay. So here total assets what we have calculated. So total assets, it is given in the information 9,70,000. 9,70,000. So total here intangible assets will not come, rather they will be capital employed. So total assets 9,07,000. One is total asset plus increase in the value of revaluation 9,70,000. Then next one is preference dividend minus preference dividend minus preference dividend. So 33,000. Yes. Preference share capital. So instead of preference dividend, we have preference share capital. Preference share capital. So that is required to be done. So 5,50,000. 5,50,000. So 4,20,000. 4,20,000 is the average capital employed. Okay. So from the total assets, we have deducted preference share capital. Okay. Yes. Next one is to come back to calculation of normal profit. Average capital employed is 4,20,000. 4,20,000 into NRR is 8%. So divided by 100. So 33,600 is the say normal profit. Now calculate super profit. Super profit is equal to average profit minus normal profit. So average profit we are calculating is 42,000. 42,000 minus normal profit 33,600. 33,600. So difference 8,400. Okay. Next, goodwill is equal to super profit into number of years. Number of years purchase. So super profit is 8,400 into number of years purchase is 5. So 8,400 into 5. So rupees 42,000. Rupees 42,000 is the goodwill. Okay. Now come back to this earlier adjustment. Okay. Come back to this earlier adjustment. So here you are observing in the first aspect. So goodwill we have calculated as per working note number 1. Okay. So it is 42,000. 42,000. Total. So it becomes 10 lakh, 12,000. Okay. From this we require to deduct minus preference share capital. Share capital. Okay. 5,50,000. 5,50,000. So 4,62,000. 4,62,000 is the net assets available to equity shareholders. Now, intrinsic value. You know the formula? That is net assets available to equity shareholders divided by number of equity shares. So net assets available to equity shareholders 4,62,000 divided by total number of equity shares. So 35,000. So rupees 13.2 is the value of equity share as per intrinsic value or net asset method. So only one here we have calculated. Say in the next class, I will speak on that is on the yield method. Okay. If you have any doubt, you can ask. Thank you.